In our today's video we are going to learn some strategies for risk management to protect our investment. So let's go. Risk management is essential for protecting investments and reducing potential losses. Here are some strategies that investors can use to manage risk effectively. 1. Diversification. Diversification involves spreading your investment across different assets, industries, sectors, and geographic regions. The idea is that if one investment performs poorly, the impact on the overall portfolio is mitigated by the positive performance of other investments. Diversification helps reduce the risk associated with any single investment. For example, instead of investing all your money in a single stock, you could diversify by investing in a mix of stocks from different industries, bonds, real estate, and other asset classes. Exchange-traded funds, ETFs, and mutual funds can also be useful tools for achieving diversification, as they represent a basket of different assets. 2. Asset allocation. Asset allocation is the process of determining how to distribute your investment across different asset classes based on your risk tolerance, investment goals, and time horizon. Each asset class has its own risk and return characteristics. Generally, assets like stocks are considered riskier but offer higher potential returns over the long term, while bonds are considered less risky but may have lower returns. By allocating your investments appropriately based on your risk tolerance, you can manage the overall risk of your portfolio. For example, a young investor with a long time horizon and higher risk tolerance might have a more aggressive asset allocation with a larger portion allocated to stocks. On the other hand, a retired individual with a lower risk tolerance might have a more conservative allocation with a larger portion in bonds or cash. 3. Stop-loss orders. A stop-loss order is a type of order placed with a broker to sell a security if it reaches a specific price. The purpose of a stop-loss order is to limit potential losses in a declining market. When the security's price reaches the predetermined level, the stop price, the stop-loss order becomes a market order, and the security is sold at the prevailing market price. For example, if you own a stock that you purchased at $50 per share, you could place a stop-loss order at $45 per share. If the stock's price drops to $45 or below, the stop-loss order would trigger, and your shares would be sold to limit further losses. 4. Dollar cost averaging. Dollar cost averaging is an investment strategy in which an investor invests a fixed amount of money at regular intervals, regardless of the asset's price. This approach allows investors to buy more shares when prices are low and fewer shares when prices are high. It helps reduce the impact of short-term market fluctuations and minimizes the risk of making a large investment at the wrong time. For example, instead of investing a lump sum of $10,000 in a stock all at once, an investor might choose to invest $1,000 each month over 10 months. This way, they buy more shares when the stock price is low and fewer shares when it's high. 5. Hedging. Hedging is a strategy used to offset potential losses in one investment by taking an opposing position in another investment. The purpose of hedging is to protect against adverse price movements in an asset. For example, if you own a portfolio of stocks and are concerned about a market downturn, you could hedge your positions by purchasing put options on an index that represents the overall market. If the market declines, the value of the put options would increase, offsetting some of the losses in your stock portfolio. 6. Research and due diligence. One of the fundamental risk management strategies is to conduct thorough research and due diligence before making any investment decisions. Understanding the fundamentals of the assets you are investing in, such as the company's financial health, growth prospects, industry trends, and overall market conditions, can help you make informed decisions and avoid unnecessary risks. By being well informed about your investments, you can identify potential red flags and react appropriately to changing market conditions. 7. Emergency fund. While not directly related to the investment portfolio, maintaining an emergency fund is a crucial risk management strategy for personal financial security. An emergency fund is a pool of readily available cash that can cover unexpected expenses, such as medical emergencies, job loss, or home repairs. Having an emergency fund can prevent you from having to liquidate investments prematurely during times of financial stress, which could result in losses. By having a safety net in the form of an emergency fund, you can maintain the integrity of your investment portfolio and avoid making rash decisions due to financial pressures. Remember that no investment strategy can completely eliminate risk, but these risk management strategies can help you reduce potential losses and achieve a more balanced and stable investment approach. It's essential to align your risk management strategy with your financial goals, risk tolerance, and time horizon, as everyone's circumstances are unique. If you learned something valuable from this video, make sure to hit the like button and hit that subscribe button.